Hey, it's me, Julie Paez. I'm the team leader of the JWP group at RE/MAX, and today I have the pleasure of sitting with Mr. Chris Seeliger here from Seeliger's Appraisers, and we're going to talk a little bit about the appraisal process, all things appraisal today. So if you have any questions on anything we maybe don't dig deep enough into, we're going to have all of Chris's information there so you can reach directly out to him if you do have follow-up questions, but we're going to hit a lot of stuff today, so check below because we're going to have the outline of all the topics we cover, so if you just want to go to that section, you can. But let's start out by, why don't you tell people a little bit how long you've been in the business, what you kind of do, where you are located, and where you hold all work. So you're pretty much the whole Northwoods, correct?
Partially. So my name is Chris Seeliger. I've been doing real estate appraising for 20 plus years. I actually started in high school as an apprentice in the summer helping out.
Wow.
Went to college for 2 years and then got right into independent schooling for appraising. So I've been full-time since 2000.
Wow.
So a lot of years under my belt, especially for my age. I'm a very experienced appraiser for my age.
Yep.
I cover mostly the Monaco Lakeland area,
Okay.
St. Germain, Eagle River, and then down towards Rhinelander. So that's my primary coverage area.
Awesome.
And I do anything from single family residential stuff for purchases, refinancing, new construction, vacant land, and then a lot of estate planning,
Kind of
things
things
of
like
that. Yep, private party stuff.
Private party stuff. That's awesome. So I know, so you got in right around the same time, I think, that I got into real estate. So that's awesome. And your mom was an appraiser, correct?
Yes.
For many, many years, which
Yep.
is awesome. So you get kind of, you also have her as a wealth of information as you were learning the business, which
Correct.
is fantastic.
Correct. Yes.
Awesome.
Yes.
So how crazy are you? I know a couple of years ago when we talked, you were like stacked, packed, and racked, and so far out it was crazy.
Yeah, for the longest time we were running, most of us appraisers were running 10, 12 weeks out.
Okay.
And that's just based on the nature of how long it takes to write a report, but then also the coverage area. We
Okay.
cover a large area based on a more urban setting where some appraisers only travel a couple miles and that's their coverage area. We might be doing 200 miles in a day for us. Right now it is not as busy because interest rates are higher
Mhm.
and inventory is low. So there's just not that much activity right now. I was fairly busy this summer with a lot of private party stuff for estate planning,
Okay.
which is typical in the summertime. People are up here and we do more private
They're-
party stuff.
And they're spending the summer here, and that's a good time for them to dot their I's and cross their
Correct.
T's and get all that stuff done.
Correct.
Awesome.
Correct.
So that leads me to the first questions one of our team members had was, what is the average cost of an appraisal?
Average cost up here is typically right around 500 to 550 for
Okay.
an appraisal. But that can change greatly based on the lender's requirements, the type of appraisal that's needed, the complexity of the appraisal, and things of that nature. My starting fee for FHA is $750,
Okay.
just because it's more detail, more work, more things that I have to do at the property versus conventional. And then higher end homes, boathouses, guest houses, pole buildings, additional buildings, or just square footage of a home
Okay.
can factor in my time, so then my rate goes up.
So if you have a 10,000 square foot estate with 3 guest cabins and a boathouse and 500 feet of frontage, that's going to be quite a bit more money than your 3-bedroom, 2-bath city home.
Considerably, yes.
Which makes
Yes.
sense.
Yes, and most lenders will contact us, or even private party will contact us. We have to look up the property first before we accept the assignment.
Okay.
So there's a lot of research that we do up front to kind of get an idea of what the property is, and then we can kind of bid our fees based on that.
Awesome. So which leads me to one really big question that I've started to see a little bit more of in the last couple of years. I know for myself personally, I work and I service northern Wisconsin. You will not see me go and sell a house in Madison, Milwaukee, just because it's not my market area. I don't know it well enough. I'm not going to be able to properly serve that client. I see once in a while where we'll get appraisers that I don't see in the MLS. I've never heard their name before, and they're coming up here to do an appraisal for somebody for a loan because the bank is in southern Wisconsin. And I guess my question to you is that typical and normal in the appraisal world, or like, because I know that's something I don't do, but how does that work?
Yes and no. Legally, we're supposed to be geographically competent for that area, and we are supposed to legally have access to MLS
Okay.
in the areas that we are doing. If we are not, we can still accept an assignment, but we have to prove that we are geographically competent before we finish the assignment.
Okay.
But yes, it's a common theme that we are seeing, and the issue with that is that's occurring, and then the appraisal goes to underwriting, and then all of a sudden us local appraisers will get a call back and saying, oh, they threw this appraisal out because they don't know what they're doing, and now they're in a rush to get a new appraisal done when we're already busy and everything like that. So it is a common thing. I don't do it. I cover my area and that's it. I stopped going to like Boulder Junction, Mantuish Waters and stuff like that. I stopped going to Tomahawk just because my area was getting too big.
Yep.
And I couldn't keep up with all the different markets. So I shrank my coverage area down. So I'm better prepared for the market that I'm covering.
That makes sense. I know, because I know my question when I see an appraisal whose name I don't know is like, how are you going to get the comps to properly provide value for this client? Because if you can't get access to our MLS, how are you going to possibly have anything to say in an appraisal report? Well, good. Well, that helps answer one of my questions. We're still in the land of the appraisal company reaches out to you, so you really don't have any contact with the bank.
Correct.
So banks cannot call you. They cannot reach out to you, because I know one of the clients, the people that we deal with on the buy side of things are always like, well, just have the bank call the appraiser. Well, we try to explain to the consumer that the bank is not allowed to touch base with you.
They can touch base with us.
Okay.
We cannot talk value with them.
Okay.
But they can touch base with us, but most banks use a AMC, appraisal
Okay.
management company, and they reach out to us and hire us.
And then they are the ones that do the communication.
Yep. So we don't have direct contact generally with the bank itself.
Okay. So realtors can reach out to you, because I know I reach out to you all the time.
Yep.
Can consumers, like buyers, if a buyer is in a transaction and they know that you're the appraiser who was picked for the job, can the consumer reach out to you with questions?
They can. I cannot talk to the consumer about value though.
Either. Okay.
So if a bank orders an appraisal for either a refinance or a purchase, the bank is actually my client, and that's who I have a direct relationship with.
Okay.
And if that bank uses an AMC, my communication has to go to the AMC. The AMC goes to the bank.
Perfect.
So even though the bank is my client, I don't have direct contact with them. It goes through the AMC. But past that, the bank is the only person that I can talk to about value or a valuation process of the appraisal.
Perfect.
So even on a refinance or purchase, I can't talk to the consumer about that aspect.
I love that. So that's a really good note for people to understand. He is an island unto himself and not to be harassed by the public.
Yes. Yes.
Which leads us to another great question. Something I get to ask all the time is, are refis done differently than when there's a home purchase? So can you answer that for people?
Yeah, so no. And like we get contacted by people all the time, well, I want a true appraisal, not a bank appraisal, or I'm not selling my property, or I am selling my property. Appraisers come up with market value, and it's what the market is willing to, as a normal market, willing to sell the property. So you as a homeowner, what would you really be willing to sell the property for in a normal market? And me as a buyer, what would I be willing to pay in a normal market?
Sure.
We do everything based on market value. So it doesn't matter if it's a refinance, a purchase, or whatever, home equity line, market value is market value on the way that we treat it as an appraisal.
Okay. And then Chris just mentioned something else super important, that if you're doing a refi and he shows up to do that evaluation, what are the words you are not allowed to tell him?
We cannot be persuaded by anything. So anybody that comes, if we go into a refinance and say, I need X to make this loan work, at that point we legally have to walk away from the assignment, because we cannot have any predetermined number. If a bank contacts us or a realtor contacts us and says, this has to come in at this, or we need at least X to make this work, at that point we have to legally decline the assignment and
Awesome.
walk away.
So very good point for people to know. Especially if you're doing a refi, you cannot, if the appraiser comes to the house, do not try to basically interfere in that process.
Correct.
And give him leading what you need, because that can make him in a spot where he has to basically reject your job, which takes more time, and we don't need more time spent on appraisals, that's
Yep.
for darn sure.
Yep.
Awesome. Okay, The next question that we had from the team was, what is considered finished square footage? Example, subfloor exposed, painted block, a basement that's 3/4 finished without a ceiling. How do you guys look at that? What do you guys generally consider finished square footage?
So finished square footage on any level is a finished floor, walls, and ceiling.
Okay.
And with that finished floor, walls, and ceiling, it has to be something that's similar to the rest of the home. So you go down to the basement and you
Okay.
have painted concrete walls. That's not finished because your upper level doesn't have painted concrete walls. It has drywall or wood. So that's not part of a finishing area. You go to the basement, like you said, and you have an unfinished ceiling, or maybe you have ceiling tile framing up, but the tiles aren't there. It's not finished. So that whole area cannot be considered finished area.
Okay.
Period.
What do you, the question that we get constantly, because in my end of the business, I'm very specific on septic systems. So if you have a 5-bedroom house with a 3-bedroom septic, we're always like, it's really a 3-bedroom house because the septic is sized for 3 bedrooms. But I know I hear a lot of questions about like a 4-bedroom septic, they upgraded the septic, but 2 of the bedrooms are downstairs. There's an egress walkout, but one of the bedrooms doesn't have a closet or it doesn't have a window within that bedroom.
Okay.
How do you look at bedrooms?
For the most part, a bedroom does not have to have a closet.
Okay.
So that has been out the door for a while. It does have to have a window, an illegal window for ingress and egress access directly outside. So you can have a room in the basement that has a walkout, and that room, like you said, does not have a window, cannot be classified as a bedroom.
So that seller that put 2 bedrooms downstairs in the back of the basement, there's a rec room right here, and there's huge patio doors that go out. Neither of those 2 bedrooms have a window.
They're not bedrooms.
They are not bedrooms.
No.
Good to know, because I think there's a huge amount of confusion about that, because I think a lot of people think if there's an egress that would take them outside if there was a fire, that they would still have a legal bedroom.
Yep, nope, it's gotta be direct access from that room. And then in basements, the windows have to be a certain height off the ground and they have to be a certain size.
So that body can get their butt through there.
Yep, and then from there, if it is, that window is built into the ground there has to be ladder access based on how high the ground level is from the window.
Okay, good to know.
So you can't just have a window that opens up to a big hole and there's nothing to get you up to ground level and away from the home.
Yes, okay, so, and I always think of if a fire was here, is there a way to get out?
Yep.
And that makes sense. Awesome. All right, the next question we have are, what are the specifications that make a USDA, FHA, or VA loan so different from a conventional loan? And what can we as agents look for when we're helping to qualify the home for our buyers? We get this question all the time. A lot of people assume every loan is a conventional, so when they're looking at houses, they think, oh, I'm just getting a conventional loan, and then when we get the pre-approval or we talk to the lender, we know it might be FHA, USA, or VA, and now that sends off certain bells and whistles with certain homes that you look at. So
Yes.
what are the big things that the buyers and the realtors should be looking for?
The big things are safety concern issues with the home. Secondary market looks at that as well, so we
Okay.
have to note anything that's a safety hazard. But FHA, USDA, VA goes a little bit more. They want cost secure for these items. They want to know how it's really affecting the property. Generally, they want those fixed prior to the sale, where in a conventional, we might just be able to mention this and they're not concerned with it as long as it's noted.
Okay.
From that standpoint, FHA also has certain guidelines, and USDA have certain guidelines. And now they both go under HUD, but they have their own handbook. So there are certain things with regard to well and septic distances, for instance. FHA is more stringent on their distances. They require 75-foot, down to 75-foot distance from well to drain field.
Okay.
The state of Wisconsin only requires 50 feet.
Yep.
USDA will go based on state and local codes. FHA will not, so you'll need a waiver from FHA for that versus USDA. And then same with the well distance to the tank. FHA requires 50, the state of Wisconsin requires 25, so USDA allows that 25 foot.
Okay.
Neither of the USDA, VA, or FHA allow point wells. Point wells are not allowed per HUD, period.
So point well in a basement with a walkout, not allowed.
Nope. And a point well outside,
Not allowed.
not allowed.
Okay, that's good to know. Another thing I think there's a lot of confusion about, because with wells it's either, it could be conforming but legal, or no, non-conforming but legal if it has a walkout for conventional. But if it's FHA, USA, or VA, they don't even want one, period.
Yeah.
Okay.
And now, and I've seen some lenders can go above and beyond what secondary market guidelines are and say, no, we're not doing any point wells, period.
Okay.
So that's their call. They can make that call
On
with
their
regards
own.
to that. But kind of furthermore on your question, a lot of things look for FHA, USDA, HUD, peeling paint, huge issue. Any kind of exposed wiring in basements or utility areas or anything like that, any kind of safety hazard, they want us to really look for that.
I think of railings when you're going downstairs. There has to be a railing.
There doesn't anymore.
Oh.
But if we feel that it's a safety issue, so if you have a open stair with
Mhm.
no walls on either side
Right.
and no railing, well, that would probably be a safety issue because there's nothing to help stop you from falling one way or the other.
Okay.
But if there's a wall on one side and no railing, that might be okay. So it can be up to the appraiser, and it can also be up to the underwriter. The underwriter can make that final call. They can
Okay.
say, no, we want a railing installed.
I think the other things I see is that's usually the appraisal where if you do not have a firewall between the garage and the house, correct?
Correct.
That comes up. Railings around decks.
Yes.
Okay. I think, and then crack in a window. Like if you have a chip in a window or a crack in a window, you
Yep.
don't like to see those on those types
Yep.
either.
And any bare wood surfaces on the exterior
Okay.
needs to be corrected. Peeling paint's a big issue, like I said, but above and beyond that, if there's peeling paint, it needs to be scraped, removed from the property, and new paint applied.
Okay. It's
So
not
that's-
just something that can go in.
Correct. Correct.
Yep, seen that before.
Yep. Yep. And then another big thing, like all lenders are getting into, CO2 detectors,
Okay.
smoke and fire detectors, all levels. It's now code, and so a lot of lenders have said because it's code now,
We want them.
we want them.
Awesome, awesome. All right, our next question, Chris, is do you or when do you look at building costs on a new home for appraised value?
On new construction, we look at the cost.
Okay.
And we have to actually analyze that cost to see if there's things within that cost data that doesn't make sense.
Okay.
But cost does not equal value. And the reason I say that is I just did a new construction of a
That's
property that they had to put a well in. It was 286 feet deep. They had to hydrofracture it, and a extra pump was installed. The well costed close to $25,000. Okay, so that's added to that cost of that construction. A mile away, there was another new construction I did. Their well only costed $6,000. That added cost of those two wells didn't increase the value of that one property more
Because they got the well.
because they had the well.
Yeah.
It needed a well.
Okay.
The well's the well. Somewhat kind of going back to bedrooms and septics, typical market is going to pay for a 3-bedroom septic system.
Yep.
4-bedroom septic system could cost double. I don't have anything to show that there's any more value to that in the normal market, because that's not what the normal market is doing. They're installing 3-bedroom versus 4-bedroom.
I absolutely love that. Cost does not equal value. So here's a great example. You have a seller that did a new construction, because everybody does this when you're building your house. This is my forever home. I'm never going to sell this house. I'm going to be here forever. So they put copper gutters on. They blow out the kitchen and the screen porch. They put an elaborate fireplace in the screen porch because that's what they wanted for their design. At what point when you're looking at a appraisal of that property, does every one of those extra upgrades get the value, or is a gutter a gutter? It doesn't matter if it's heated, lined with covers. Tell me a little bit about that, because I think that's super important for people to understand.
Yeah, so with that, we look at quality ratings, and we look, based on that quality rating, we're looking at the quality of material, the quality of workmanship, and then the quality of that design and function of that aspect.
Okay.
So if you have a newer home, $300,000 value, let's say, and you have all of these homes that are similar, there's going to be certain similar features in those homes, and those buyers are going to accept or expect those features in that price range.
Okay.
But you get into a different price range, those features might change, and or the quality requirements might change. So we kind of look at everything as a whole.
Okay.
If everything in those price range have seamless metal gutters, and somebody puts vinyl gutters that are 10-foot sections, that may not have a direct impact on a line adjustment for that value, but it might affect some of the quality rating that we give to the property as a whole, because that's below the quality of what the market is going to expect for that price range.
So if you're looking at your luxury property, and if there were places where somebody really blew something out or really cut corners, it's going to be more overall the quality than the actual feature we're giving you a plus or a minus.
Correct.
Okay.
Correct.
Interesting.
So a lot of things get lumped together for the appraisal aspect of that. Generators right now, huge thing. For most properties, most new construction in a rural setting, they're putting in backup generator systems.
Okay.
They cost money, but I don't have anything in the market to show they have any added value. It's just now something that buyers are kind of expecting.
Interesting. So what I always tell sellers, and I could be wrong, but I usually tell them that some of that stuff, well, it's not going to give you a quantitative bump on your overall value when we list it. It's going to be more a features list of the reasons why to buy your house instead of buying somebody else's.
Yes.
It's not like I can say you're going to get, $20,000 more because you have a 3-car garage, because I know you guys only count usually what the first 2 cars are the most important.
Yes and no. Yes and no.
But it gives you an edge over something else that they might be looking at that has a undersized garage.
Correct.
Sort of like that.
Correct.
Okay.
Yeah, and then there's just certain things that, again, kind of going back to your cost question, someone comes in and says, well, I have imported Italian tile, and
Okay.
it costs X to put this in. Well, is the typical buyer looking for a house with imported tile, or are they just looking for a good quality tile floor that's
Okay.
designed well? And, yes, you may have this that has a high cost to put this flooring in, and it's a high-end flooring, but is the market really going to care? And how are they going to value that? And then same with some of the cost factor here. You have a $200,000 property and you go and put a $75,000 kitchen in. It's a vast over improvement.
Okay.
The market's not going to pay for that. You're not going to have a $200,000 house, remodel it, put 75 into the kitchen, and now have a $275,000 house.
Yep.
It's going to see what is the market willing to pay or expect in that price range.
Awesome. Nope, that's good to know. I appreciate that, because I know we talk a lot about, like, when you go to a seller's house and it's, which is my next question before we get off of this subject. How long is new in your world? Is it 2 years when you're still getting that sort of new value cost? And I always think of a car. When you buy a new car, you drive it off the lot, it immediately sort of becomes no longer a new car.
Yeah.
How does it work with houses?
So for the appraisal aspect for secondary market, we have 6 condition ratings, C1 through C6. C1 is brand new construction, never lived in. As soon as that house is lived in, you move in, today it is no longer a C1 condition. It is now a C2 condition. Now, there may not be any adjustment made for that, but typically speaking, some lenders look at it at 3 years. You're no
Okay.
longer new. Some will go up to 5 years as long as it's been very well maintained. But typically in that 3 to 5 year range, you're no longer new, and some sort of consideration needs to be done for at least the short-lived items within a home. Appliances, flooring, some of those kind of items may need to be adjusted versus a new home.
Perfect. Okay. So I'm hearing like somewhere around 3-ish years is usually when, as long as it's lightly lived in.
Yes.
If you have renters in there on year 1 and they beat the crap out of it, it's no longer new.
Yep.
Okay.
Yep.
Okay, is a bedroom only counted as a bedroom? Oh wait, I think we covered this one. If there's an egress window, how much value does the average bedroom have, not including a primary suite? Example, does a 2,000 square foot 3-bedroom, 2-bath have less value than a 4-bedroom, 2-bath in the appraiser world?
So, somewhat of a loaded question, and it goes back to the size of the septic. If you have a 4-bedroom home that is only sized for, or the septic is only sized for a 3-bedroom, that home, if I would list it that way, is basically legally non-conforming and a contingent upon a 4-bedroom septic being installed, which is very costly.
Yep.
So, all in all, the typical home and the typical septic up here is 3 bedrooms. I don't have the data to show that a 3-bedroom home with a 3-bedroom septic versus a 4-bedroom home and a 4-bedroom septic has any value difference. I just don't have the data to prove it. We don't have the paired sales of this neighborhood all has 3-bedroom, 3 septic systems, and this one has 4-bedroom with 4-bedroom systems, and that they're selling at $25,000 difference. We don't have that data here, so I don't make any kind of bedroom adjustment. Everything I do is based off the square footage.
Okay.
And that kind of also goes back to, you might have a den or an office or something like that you're using as a den or office. For the next buyer coming in, they might use it as a bedroom, even though it's not a legal bedroom.
Okay.
They're still using it for whatever purpose they want as a finished room.
All right, the next question. Do the quality of the fixtures, appliances, and finishes make any difference to the appraised value? I know we kind of touched on this a little bit, but carpet is carpet. Whether it costs $8 a yard or $80 a yard. I know we talked about the floor, but is there anything else to add to that question?
No, I mean, we covered it a little bit, but yes, we look for quality, not only of the components, but the quality of the design of the property as well. So to some degree, the quality of those components we look at, and that's again going back to the basis of what is a buyer in that price range going to expect.
So that if you have 2 homes that are relatively identical, 3 bedrooms, 2 baths, master suite, built in the 80s, but one of them just did the roof, just put in a new furnace, just put in a new a new hot water heater, just painted the exterior, and you have one that's relatively, everything is about 20 years old. Is it more about the cost of the new roof and the new well and the new hot water heater and all of that, or is it more of like an overall value? How do you look at that?
It's more of an overall value.
Okay.
A roof is a roof, so we kind of go back to the quality and stuff like that. You might be putting a 30-year shingle on, maybe a 50-year shingle, maybe a metal roof, maybe a slate roof, whatever. All of those have different costs.
Right.
But a roof is still a roof, it's still needed. And again, does that roof go into what the market is going to expect? We don't have a lot of slate roofs here.
No.
It's highly costly, but it's not going to be a common thing. It actually might deter a value for you to go put a brand new slate roof on than just putting a shingle roof on or a metal roof. So we look at that, but from the adjustment standpoint, this house had these updates and this one didn't. It could still be the same quality rating of homes, but this has updates. So some of us appraisers will do maybe a separate line adjustment for updates.
Okay.
And adjust for some of that stuff. Or we might just do it in the condition factor and say this has been updated.
So this has a higher condition rating versus this house.
Correct.
So it might have a overall higher square footage average price. Okay.
Yeah. But the typical consumer, you have those 2 examples again, and this brand new roof and water heater and this and that were added in here and has a cost of $50,000. The typical consumer buyer is not going to pay $50,000 more for that property because of those features. They might pay $40,000 or $35,000 or $45,000, but they're typically not going to pay the cost value.
And what I tell people is they'll say, well, I should be $20,000 higher because I just put a new roof on. And I usually say the way I look at it is the house has to have a roof, and the roof is there to protect the property from damage.
Yep.
So as long as they're going to expect a roof, but they're not going to necessarily write you a check for more because it's newer. Again, it's one of those features that might help you sell versus something that has a 20-year-old roof.
Correct.
Okay.
Correct.
Perfect.
But we do look at it in the appraisal standpoint.
And it does get a bump.
It does get a bump. And that bump could vary greatly based on, again, the price range of the property. Maybe a new roof for a price range of $100,000, $200,000 home is going to be different than for a $500,000 home.
Mm-hmm.
And it also kind of will look into what's the size of that dwelling based on the cost. You have a 1,000 square foot home, that roof is going to cost way less than a 2,500 square foot ranch.
Yep.
Because there's that much more surface area of a roof. So that comes into play with all of that with regards to some of the quality and then updates and differences.
Just curious, like, is there a rule of thumb for, like, if you have a 2,500 square foot home and one that has a new roof and one that doesn't, is there a rule of thumb? Do they get, like, percentage? Like, if all the improvements cost you $47,000, is there a general thought of, like, okay, we're going to give you approximately 35% of that or 40% of that? Is there any
Nope.
to make sense in people's brains?
Nope. So what we look at then is try to find a comparable that has had some updates.
Okay.
Maybe not the same update. Maybe this one had a new roof, like you said, but this one has had a new kitchen
Okay.
or new siding and
Furnace
windows or
okay.
whatever. So we try to find comparables that have had something, and we also try to find comparables that have had nothing, and then see where they adjust out without making an adjustment for that factor,
Okay.
and say, hey, they're adjusting $10,000 difference. Well, that roof had a $10,000 value. It might cost $20,000 to put in, but the market was only showing $10,000 of added value.
Okay, that makes sense. Okay. Okay, along those same lines, talking about real estate, how much does quality of the frontage matter, like sand versus fisherman and weed, steep, I hate to say, but as we realtors like to say, Canadian views versus level. Those are questions that sometimes for me as a real estate professional, it's hard to exactly quantify, but trying to find the comps that have the same sort of approach or frontage type. And then COVID came and all the rules went out of the window. So I guess, how do you guys kind of look at that?
So that's a tough question, and it's one of those things that there's no true answer for.
Okay.
It changes on a regular basis. So like you just said, COVID came and that went out the window. People now are looking for, if they want to be on water, that's a primary concern. Whether it's level frontage, steep frontage, mucky frontage, sand frontage, people just want to get on water.
Okay.
So I'm seeing on my end that right now, for the most part, they don't care. The normal consumer who's looking for a waterfront property doesn't care. Does everybody want level sand frontage? Yes. Does it have a value factor? Yes. But that factor is different based on the markets right now, but then also the location of the properties. Eagle River chain has different values than the Minocqua chain versus the Three Lakes chain. The chains themselves dictate some of that, and then non-chain lakes, and then their location also dictate some of that kind of stuff. So there can be a more rural lake that's large in size, level sites, sand frontage, but because it's 20-30 minutes away from town, it's not commanding the same as something that's closer to town that's got muck frontage.
Yeah, interesting.
Because people don't want to go 30
that
miles
farther
away.
out of town.
So lake to lake, chain to chain, market to market, all has a bearing on that. And that's a reason that appraisals, especially for the waterfront, can be higher in cost, because we have to analyze that.
Okay.
And then also why it's time consuming and we are out sometimes as far as we are, because we have to analyze what's going on in the market now with those types of properties.
So that being said, along that same line, so if you are doing an appraisal on a chain property, you're going to try to keep all of your comps to chain properties.
Correct.
Do you look at chains differently? So would you compare Minocqua to an Eagle River or to a Manitowoc Waters or a Rhinelander, or do you try to keep them within the same chain?
Try to keep them within the same chain.
Okay.
typically speaking, in my experience over all the years, and I know I talk to agents, and agents will say, you know, no, we looked at this chain and this chain and this chain. Typically speaking, though, in my experience, when I actually talk to a buyer, if they're looking on the Minocqua chain,
They're looking on the Minocqua chain.
If they're looking on the Eagle River chain, they're looking on that chain.
Yeah.
They might look at something else somewhere else, but 99% of the time they're going to buy on the chain they want. And that's generally either because they have family in the area already, they grew up in this area or vacation in this area, and they have a personal interest in that chain or that location.
Perfect. And I guess the same thing I would say then for the standalone lakes. If you're looking at like a 650 acre lake, you're going to try to stick with 600, you know, somewhere between 5 and 7.
Yep.
Okay, that's kind of how I look at it on the CMA side of things. You know, I try to do like for like. And then I also try to do frontage for frontage. If I can find a fisherman weed with a fisherman weed on the same size lake with a similar home. Sometimes up here though, it's just hard.
Yes.
It's just hard.
Sometimes it's just not possible, and there's times on my appraisals I might make $100,000, $150,000, $200,000 site adjustment because I just don't have the comps of a similar house on a similar site on a similar chain or lake, and I have to use something different. So maybe I focus on the dwelling or the improvements and make a larger site adjustment, or maybe I focus more on, if it's a high site value, I'm focusing on the site and not as much on the dwelling.
Okay.
And then sometimes I'll use both of those types of comps on that same appraisal
But just make
to see where they are falling out.
So the question I get all the time, which I have to ask because everybody asks me, are you still doing per fund foot? I have a 271 foot lot and I want to know what I'm going to get per foot. And I said, I know before COVID it went out the window because it was more the first 100 foot that was buildable and if it was dividable. But now how are you guys looking at it? Did that change at all with COVID?
Yes, and your answer is correct as well. I would say I noticed a difference in 2008 when we started to see the change in the market.
Yep.
That concept went out the door.
Yep.
Most buyers, depending on the lake, again, and then depending on the chain, most sites and most buyers want that 100 to 150 foot parcel. That's your prime parcel.
Yep.
Nowadays, my understanding from most buyers is, okay, this site has 125 feet and this site has 175 feet. They have the exact same frontage, slope, view, all that factor. The site size itself is very similar. Buyers are coming in and saying, well, I don't want to pay more and have more taxes for 50 more feet if my bundle of rights for that front is the same. They both can put a dock out, they both have swing frontage, they both have access to that lake. Why do I want to pay more? So in my opinion, that per front foot valuation and looking at was ego driven. and I hate to say it, but at that time, that's what people were looking at. Oh, I have 100 feet. Oh, I have 150 feet. Mine's better. That went out the window, I think. And I think people now are just trying to look at, can I get on water? Can I afford to get on water? And then where do I want to be on water?
Perfect.
So yeah, I would say no, that front foot out the window.
That's what I usually tell people too, so thank you for that.
Yes.
Okay, so now we get to get into some of my questions.
Okay.
So, giving value to like remodeled kitchens, bath, masters in an older home. So a lot of the home is like that original 1980s style or 90s, but then they went in and they blew out the kitchen or they added a master suite, something along those lines. It doesn't elevate the entire value of the entire home, but they did those couple of pieces. How do you generally look at those things?
So that's another difficult question, and it kind of goes back to the price range and the quality of property that you're in. A lot of buyers like that it's done, so they don't have to do it. But a lot of buyers come into it saying, well, that's great, it's done, but everything else is not.
Gotcha.
And they want everything else to be done. I think a lot of buyers have tunnel vision and or not the patience or desire to actually do the remodel themselves, hire somebody, pick everything out. So in some cases, I have seen that you going into that 80s house and remodeling just the kitchen and bathroom has a negative effect on that property because that's the only thing that's done.
Gotcha.
And definitely from a value standpoint, at least the way I do it and this research and data that I have is, say that costs $20,000, $25,000 to do, or maybe $50,000 to do. You're not going to get even close to a dollar to dollar factor back out of that because the rest of the house hasn't been
Updated.
The whole quality rating of that home hasn't changed because it's still original, older, everything like that. We look at the percentage, I guess, of the actual dwelling and all of its components and what's been updated and what hasn't. So
Interesting.
just doing a kitchen or bathroom, yeah, it might have good appeal, but you really may not get dollar for dollar. If you're going to do it, possibly either wait and do it all at once, or
Interesting.
maybe work on some of the long-term items, siding, windows, roof, the more expensive items that a lot of people can't necessarily do when they're purchasing a house right away because of those
Perfect.
big ticket items.
That makes sense. So, because that'll be a question that I get a lot is of like family members or older folks that have had their lake home or their home up here for 20 or 25 years will say, well, we're getting ready to sell. Should I sell it as is, or should I dump a bunch of money in it to improve it in order to sell it? Because I know I'm going to get a lot more money if I improve it. And I guess I'd be curious to know how you would answer that versus how I typically answer it.
So kind of the same way I just did.
Yep.
It's really going to depend. Say you have an older home or even a cottage. What's the functionality of the floor plan and design of that home? And now you go put a modern kitchen in. Does that modern kitchen and the functionality of that fit the rest of the house? And then does that house allow for a modern functional kitchen?
Okay.
So
Makes sense.
kitchens are getting bigger and bigger. They're more open space. You're seeing a lot more availability of selection, cabinets, designs, colors, schemes, all that. Can this property support a new modern kitchen?
Interesting. That's a really good way of looking at it.
So I do look, I mean, we look at that, and yes, it can be an added bonus or an added value factor, but typically in something like that, it may not break down to a dollar. So you may not get all the money back. And a lot of people see all the, shows on TV. Oh, I just redid the bathroom, or I just redid the bathroom, or kitchen, and I got $20,000 more. In some markets, that might be viable. You might actually be able to do that in some markets. In our market up here,
Doesn't work. I'm more about the structure. So I'll say, if the roof needs to be redone, let's redo the roof. If the furnace needs to be replaced, let's do those things. Because those things, in my opinion, make the house, the overall property more appealing because they know they're not walking into a mess.
correct.
Because it might be older, but it's solid.
Yep.
Versus making it, and of course declutter and all the other things that you can do, but not necessarily. And the time it can take up here right now to redo a kitchen or a master bath, this market might have completely shifted in the 2 years you're waiting for a contractor to get in there to do those
Yes.
things. Is the other way I look at it. Time is money.
Yep.
So there's a value to that too. So good. Well, I'm glad I'm hearing that. The other thing I used to always go, National Association Realtors usually gives us once a year what you get for your return on an investment in a house, and I usually say it's usually between 45 and 50%. Like if you put $50,000 in a kitchen, if you get 20 to 25, you're doing pretty good.
Yeah.
So that's kind of the other thing I usually sort of use as a rule of thumb.
Yep.
Good.
And I always advise people on some of this stuff. I get calls a lot of times. Should I do this? Should I do this? Should I do this? And if you're going to stay in the home when it's your home, do what makes you happy.
Yes.
You may
What's going to
not-
bring you joy?
Right. You may not get a dollar return for that, but is it going to make you happy? Is it going to make your experience of living in your home better? Then by all means do it. But if you're going to get a dollar for dollar return, no. You typically just don't, up in this market, get a dollar for dollar return for anything.
Perfect. That makes 100%. Same thing since we're talking about that. A lot of times I have the seller that's got the attached 2.5 car garage, but then he did his big blowout of a pole building at the end of his street. And that pole building cost me $150,000 because I've got the cement floor and I've got it insulated and heated and I've got all the extra outlets. Does that second pole building give them $150,000 worth of value? Or is it just, how do you guys look at those detached garages?
Typically not. And so for me right now, with COVID, since basically 2019, 2017, 18, I started noticing a change in the market with garages.
Okay.
COVID came through, and it definitely kind of, there was more data to show stuff. I make a per stall adjustment. So if a garage is, 800 square feet garage, and it's got a single overhead or 2-car overhead door, I might value it as a 3-car garage based on its size.
Okay. Good to
Versus
know.
just having a 2-car overhead door being a 2-car garage. Buyers, I think, are looking at that. I mean, in our market up here, garages are
Huge.
important. They are huge, yeah. So I try to make a value factor for that. Now, the data in our market, you have that same size garage that's attached and one that's detached. I don't have any data to show an attached garage has any more value than a detached garage.
Isn't that crazy?
Everybody wants the
That's
attached garage, but the sale prices don't justify it. And then, so I look at that kind of stuff. Same with, you got a finished garage, unfinished garage. Again, my data doesn't show that a finished heated garage has any more value than that attached non-finished garage.
Interesting. I love that
So-
because we get a lot of, we have a lot of garage pride in
Yes,
Wisconsin.
yes,
So
yes.
it's good to-
But but then to go back to your whole building, again, that goes back into what price range are you in,
Mhm.
and then what is typical. So, say you're in a $300,000 off-water home property. How many people are building $150,000 full buildings? If not that many, which is the case, not that many
Right.
people are. That's an over improvement. You're not going to get that, and I have to address that in the appraisal. This is an over improvement for
This price
property,
range or
this
this
price range, yeah.
Okay, that makes sense.
But yeah, from the whole buildings, you finish them, you put a second story in there or whatever, you could just be spending your money. So, and then the other factor with that is a value in use. You're building this building to be able to put all your equipment in there. Maybe you even work out of your home. That building is built for you, by you, for your need, for your value of use. The next buyer coming in may not need it.
Yep, that's very true.
Or so they're not going to pay
It won't be of
for that.
importance to them like it is to you for how you're using your
Correct.
property. Nope, that
Correct.
makes sense. Awesome. Okay, I think, this is a good question. If a property doesn't appraise for the purchase price, is it still a good idea to purchase the property? And I know that this is a question we get, and I think it's a loaded question because it depends on the buyer. But I guess you probably saw a lot of that in the last 3 years where they bought a property, they turned around, tried to pay cash, turned around and then appraised it after to do a loan. Are you still seeing where they aren't appraising for value after closing? Or is
Yes.
that sort of calmed down?
It's calmed down. It's calmed down just from the standpoint of there is no inventory, and so there is not much happening because there's no inventory. I mean, I know you guys are busy
Mhm.
with things. There are still a lot of cash offers going on where their appraisal isn't being done because it's a cash offer. But through that time, yes, there was a lot of they're paying X, and the appraisal is below that. We are looking at market value. We're looking at the typical buyer and the typical seller in a typical market
Right.
standing or setting. So COVID is not a typical market. So some of that aspect of all of that you have to throw out the window. You have to say, yeah, every single property got in a bidding war because the high demand. Well, that's not a typically motivated market.
Mhm.
It's a stressed market.
Yep.
So we look at that. To answer the question, it is a loaded question, and it's really up to you, like you said, to the buyer. Some buyers that we know have been looking for years,
Right.
and now they're at a point where I'm sick of looking.
I want to buy.
I want to buy, period. I'm willing to spend X. You find me something for up to X, we'll buy it, regardless of what it is. They have the funds available, so they're not looking at what the value of that property really is. They're looking at, I want something now. So I can't, for that buyer, yeah, you pay more for it, but that's what you want 'cause you're tired of looking. Same with new construction right now. New
Yeah.
construction costs are still high. Interest rates right now are high to get into a new construction. Some people are just sick of waiting,
And they're just
so they're
gonna do
just
it.
going to do it. They're pulling funds for something else, from somewhere else if they have them, put more money down. I can say in that question, I saw over the last 3 years a lot of people coming in with a offer, and they stated, we understand it may not appraise out, we have additional funds to cover the gap difference between the purchase price and the appraised price.
Yeah.
Already knowing that they're overpaying for the property,
Yeah.
still willing
Still
to do
willing
it.
to do it.
Yep.
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 I think, and I think that goes back to your cost is not necessarily equal value.
Yeah.
Because value to some people is, like you said, getting the property and being able to start out and get up to the Northwoods, which
Yep.
is what a lot of people
Yep.
do.
I will say on that, there is some things I do warn people about, that if you're already tight, or this is going to be a tight situation, if you buy that and say a year from now or 2 years from now, the market changes and
Yeah.
or rates go up and you have to refinance or you have to take money out. You overpaid for it originally, which could have been fine, but now maybe you're underwater. Now you're in trouble. Or now, because you have to refinance or do something, the rates aren't as good. You now no longer can afford that payment, what you could before.
Yeah.
So I do warn people about that. Like,
Be careful.
you're taking the risk here. Here's what the market should be paying. You're paying more. There's your risk.
There's your risk. Nope, that makes perfect sense to me. I think you have got and answered all of my questions. Is there anything I didn't ask you here that you typically get asked that you really would like to be able to tell people about, or something that you feel strongly people should know about what you do for a living?
Everything was really good questions. A lot of what I see on a normal basis. I would say the big thing right now is, as of last year in April, we have to go by ANSI standards for measurements and everything like that. And I don't want to get into too much detail with that. But the big thing with that, and this has always been the case with appraisals, we look at a home as above grade and below grade, and they're two separate entities. You can't have a 1,000 square foot house with a 500 square foot basement and call it a 1,500 square foot home. It's a 1,000 square foot home with 500 feet finished basements. That 1,000 foot home is going to have a different value than a 1,500 square foot house. The cost to build that $1,500 square foot house is more than that 1,000 square foot house.
Because it's above grade versus
Because it's a
below
bigger grade. You have a bigger roof, you have more windows, you have more walls, the foundation is bigger. So you can't just compare
Square
finished square footage to finished square footage. There's factors that go into that. And then
Good point.
with the appraisal, and this is the big thing that we see, we separate it. There's above grade GLA, gross living area, and room count, and there's below grade, and it's separated on the appraisal that way, and we look at it that way with the comps, the subject, everything.
And no matter how you do it, below grade is always less value than above grade.
Correct.
Yeah.
Correct.
That makes perfect sense to me.
Yep.
Yep.
And again, that goes back to, you take that basement level and you move it over here, and you take the above grade area and you have it by itself. The basement area does not have siding. It does not have a roof. It's got a floor system over it from above, but it doesn't have a finished roof, shingles, gutters. The window count is normally lower in that basement versus the above grade one over here. So there's a lot of factors that go into that the cost of those two are very different. So the valuation of that is very different.
Awesome. Nope, that makes perfect sense. No, and I know that's something we're always working on as realtors is to be as professional as possible in our data entry to help make your life a lot more easy.
Yeah.
Good. Well, I appreciate it.
Yeah.
If you have any other questions, reach out to us. All of Chris's information is here if you have any questions specifically for him. But thank you very much. I appreciate it.
Thank you very much.
All
It was
right.
fun. Thank
Yeah,
you.
it was.
All
Thank
right,
you.
Thanks.